Hi, thank you for joining us for this week's Ask Amy. It is getting to the end of 2022. Time to start thinking about your taxes. And that is why this week we have asked Alan Pruitt, the CEO of Pruitt Prep CPA, to join us to talk about all things tax related. It's not something a lot of us like to talk about. That's why you have the title of CPA.
Absolutely. Thank you, Amy. I'm so excited to be here. Yes, not a fun topic for most people, but absolutely love it. So I always try to guide people through it as best as possible and make taxes as easy as possible.
And help people. I mean, I say save money, but the less taxes you have to pay, then the more money you can save for yourself.
Absolutely.
Here we are in December. Are there some things that people can do now to try to have a lower tax bill come April?
Yes, absolutely. I would say so. So one of the first things I always think is great to do is to make sure that you are maxing out your job 401k. So that is the first thing, at least up until the match. If your job has a match for your 401k, you should always be contributing up to that match because that's free money.
Yeah.
And I don't know about you, but I love free money. So I always say contribute up to the max for your job. And that way you get your contributions, you get their additional contributions. And so that's one of the first things that you should always do.
And this is money that's, automatically usually coming out of your paycheck. So you don't miss it, and it's tax free. So if I go in and I can see how much I've contributed this year, what is the number that I'm trying to get up to? What's my maximum that I can contribute?
Absolutely. So your maximum amount that you can contribute is $20,500 in 2022. So if you're a little bit under that, you can go up to that number, but they will stop you at that $20,500.
And what does that do? So say I contributed 18. I mean, is it really going to benefit me to put in an extra $2,500?
Yes, I think it does a couple different things. One, that extra amount gives you extra savings now that will grow in the future. So people often miss that piece of it. But yes, it also decreases your taxable income. So let's say you're someone who makes, keep the math simple, $120,500. Well, usually that's the amount that you would pay taxes on your tax return. However, if you're contributing that $20,500, now you're only paying taxes on $100,000. So it gives you tax savings now, but then it also gives you that money to put into your retirement that will grow for the future.
Okay, so that's the first thing. Check your 401k and your contributions and try to max that out at $20,500. This tax year is a lot different than last year.
It is very
different. We had a lot of incentives. I mean,
yes.
Bonus stuff. I mean, talk about that. I mean, we had that advanced child tax credit. You could get it in advance, at least half of it, but also it was a lot more than normal.
Yes.
So talk a little bit about that if you can.
Yes, absolutely. So a lot of different changes this year. The IRS has already warned for most people to expect a lower refund this year. So there's for a few different reasons. One of the reasons you just mentioned is the advanced child tax credit. So they increased the child tax credit up to $3,000 for children, and then they gave you basically half of that you received in those direct payments on the back end of 2021. Well, that is now gone. And then also the standard deduction for a child has gone back down to $2,000. So you get a $2,000 credit for kids 17 and under.
Okay.
And so where that was increased to $3,000 in the previous year. So now we're back down to $2,000 there.
Okay, so that is significantly less. So you're working with that. We also, in years past, before the pandemic, had kind of gotten out of the habit of all of these itemized deductions because the tax law had changed where you really had to make a lot of donations and deductions for it to matter. Can we talk about that a little bit?
Yes, absolutely. So now that is still intact to where there's a very high standard deduction amount. So for married filing joint, we're right at about $26,000, and for single, we're right at about $13,000. So you have to have those items over that to be able to what we call itemize and get extra tax benefits. So to kind of break that down just a little bit more, because here in Texas, if you own a home, it's sometimes not as difficult as some people might seem, because the four biggest things that make up itemizing deductions are medical expenses, which is honestly tough because it does have to be 7.5% over your AGI. So if you make $100,000, then you have to have $7,500 in medical expenses. So that one's a little bit tough most times.
Okay.
But the other big three things are state taxes, what we call SALT taxes, state and local taxes, which here's your property taxes for your home. But in Texas, because we don't have a state tax, you can write off your sales tax as well.
Okay.
So we can write that off up to $10,000. Your mortgage interest is the third part. And if you own a home, if you have mortgage interest, especially now with higher interest rates, sometimes you might be paying a little bit more than in years past. So your mortgage interest and then also your charitable deduction. So let's say we max out your taxes at $10,000, your state and local taxes. Let's say you have a $12,000 mortgage interest. Then if you're married filing joint, you only need another $4,000 in charitable to be able to itemize. So that's something I always suggest to clients to make sure that they're looking at that and seeing where they kind of stack up. And then, hey, at the end of the year, we can make some charitable contributions to get you over that amount, which gives you a direct tax benefit.
All right. And so kind of just to reiterate, to go over some of the things that you were saying, the state and local taxes, you remember all the times that we've talked about, oh my gosh, property taxes are so expensive. We even did an Ask Amy episode on that and how to protest your property taxes. Well, if you weren't successful or you still think you're paying too much in property taxes, this is where that can benefit you because you can write those off or take them as a deduction.
Absolutely.
And then the mortgage interest, like you said, a lot of people are paying, if you took out a recent mortgage, you are paying higher mortgage interest.
Absolutely.
You can write that off. And then sales taxes, it really seems like it'll really benefit you if you made like a big purchase, right? Like a vehicle or,
Correct.
I mean, a big screen TV, but even those these days are not a huge amount of
it's
money.
not a huge amount, but thankfully that is grouped in with your property taxes. So if you have property taxes, let's say your property taxes, $6-7 grand, then we can make up the rest of that with sales taxes, with just regular purchases, big purchases. So yes, unfortunately, it's capped at $10K, per return. But if you're a little bit under in your property taxes, then that sales taxes can make up the rest.
So now is the time to really start going through those receipts if you've saved them, or your checks that you've written, or what do I need? Like, can I look through my credit card expenses?
Yes, absolutely. I'd say that's probably the best place to start. For most people, a lot of people use credit cards, and most credit cards now actually have that year-end summary where they kind of summarize all of your purchases, all your travel, all of your food, all of your other different supplies and purchases. So I would definitely say start looking through those items now and try to get a good idea of where you're at, because now you can kind of start planning, as we're talking about, to see, hey, do I need to make an additional charitable contribution if I have property taxes, sales taxes, mortgage interest? Hey, will this, $3,000 charitable deduction at the end of the year, bump me over and give me an extra tax benefit?
Okay. All right. And then is there an easy way before I put $3,000? Because, if somebody's looking to save money on taxes, they're probably like, oh, do I really have $3,000 or $2,000
Absolutely.
to give to bump me over? To look at it and say, okay, how much will I owe in taxes if I make that contribution versus if I don't make it? How much am I going to be on the hook for? Is there an easy way to do that?
I wouldn't say easy, but it's possible. This is why it's good to be in contact with your tax professional, because then we can kind of run those numbers for you. I know that's what I do for a lot of my clients at the end of the year, making sure we're tax planning, making sure we're in a good spot there. Because hey, if we're slightly there or over, then hey, let's maybe have a little bit of additional contributions. But at the same time, to your exact point, if we're not going to reach that amount, if we have to, contribute another $8,000 in charitable.
Yeah.
That's probably a little bit much. So that's why it's important to look at, to break it down, look at those main three items. Look at your real estate taxes, look at your mortgage interest for the year, which you can find on your, mortgage statement, and then see how much you've done in charitable. If you just add those three things up and, if they're around $13K if you're single, $26K if you're married, or around just under $20K if you're a head of household, then that'll give you a good idea if any additional charitable contributions will give you any extra tax benefit.
Okay. I seem to remember, is this wrong, that you can write off all closing costs?
You can write off closing costs, and then you can write off also your mortgage interest premiums as well.
Okay. All right. So meaning amount you had to pay down?
Exactly.
Okay.
So if you pay for points down, especially with higher interest rates now, then that amount you can write off as well.
Okay, those are also good things to know, especially, I mean, it seems like a lot of people were buying homes or trying to get in just before the interest rates went up.
Exactly.
Okay, so we talked about 401k. We've talked a little bit about deductions. There are other retirement accounts like Roth and IRA. You say those are a little bit different on when you have to make those contributions for it to count.
Yes, absolutely. So one of the best tax planning vehicles that I love are Roth IRAs, because with a Roth, it is to me a triple tax benefit where you can contribute up to $6,000 into a Roth. It is after tax dollars. But then, so I would say here's my order of operation. As I mentioned first, make sure you contribute up to the max in your job's 401k. Get that free money first. And then I would say next, go to a Roth IRA where you can contribute up to $6,000 into a Roth. So with the Roth, you contribute to it. It's after tax dollars. But then after that, it grows tax-free, and you can take it out in retirement tax-free as well. So therefore, it is a very great vehicle. And then on top of that, you can also invest your Roth into, different stocks. And to go to another level, there's something called a self-directed Roth where you can contribute to the Roth and then use it for, your own investments that you might like, whether that be a, rental property or cryptocurrency, things like that. So that is, probably a next step on a Roth, but I would say just getting started, contributing $6,000 to a Roth does great things, because to me, it does two different things. You want to have always like a little bit of variance in my investment. So you get your 401k with your job, go up to that, max amount, and then you have, a little bit of a tax deduction there, and still saving for retirement. But in a Roth, you do the opposite, where it's after tax dollars now, no direct, tax deduction now, but it grows tax free. So a little bit of a good combination there.
So in terms of how much I'm going to have to pay in taxes come April, that won't really depend on what I've put into a Roth, or it will?
So correct, no, because a Roth does not give you a tax deduction now. It's just a vehicle for you to grow tax-free over the long term.
Okay. All right. So any contributions that I make there really aren't dependent on taxes. It's just a smart idea.
Exactly. It is a very smart idea, and it is capped at $6,000, per year. But yes, a very great idea to, contribute to a Roth.
Okay. All right. What else am I missing? So tax day is April 17th, this next year coming up.
Exactly.
That Roth contribution, if you're thinking about it, you said those deadlines to contribute there are January 15th, not December 31st, like your 401k.
So actually for a Roth, you can, for your individual retirement accounts, you can actually go up until the deadline of the next year. So you can actually contribute to those up until April 17th next year.
Okay. All right. Anything else in this countdown to the end of 2022, things that I should be doing?
Yes, one of the things I love, one of the other tax saving vehicles I love are HSAs. If someone has a HSA account, then those are such great vehicles, because this is another thing that is a triple tax threat, is because you can contribute up to $3,650 individual for a HSA or $7,300 for a family. So you put that money into an account, it reduces your taxable income. So if you currently have a HSA, I always suggest maxing that out, because it reduces your taxable income. And then on top of that, what it does is you get to withdraw that money tax-free for any qualified medical expenses. And there are tons of qualified medical expenses. So think of it as, prepaying your medical expenses with tax-free money. So if for those that do have HSAs now, I suggest maxing those out. And then for those that might not have them, we're usually this time is open enrollment for jobs. So I would say start looking at your HSA options now to see if it makes sense for your family, because those are such a great tax savings vehicle and will save you money.
So if I didn't have one, so say we're already in 2022 and I didn't start one with my employer insurance for 2022, it's too late. Like I can't just go and open it. So you need to make that decision in open enrollment.
Exactly.
That either just ended or is happening right now. To make that. I always get leery and afraid of those, that I'm not going to have enough things that I want to buy health related, and then I'm just going to be at Walmart stocking up on Band-Aids to be able to use it so I don't lose it.
Well, so here's the great thing about a HSA. One of the best benefits of it is a HSA never expires.
Oh, okay.
HSA is the one, so there's two different ones. There's a FSA, a flexible savings account, and then a health savings account. The health savings account, the HSA, is the one that never expires. And even if you change jobs, it goes with you. It's essentially a bank account that has your tax-free money in it that's reduced your taxable income and is always there for you for medical expenses. So you can always contribute to it, and you can even invest your HSAs as well.
Oh.
So that's why HSAs are a great vehicle to potentially use. But yes, if they never expire, they go with you forever, and you can keep adding to them.
So I could use that for those could I use it for my copays? Like when I have to take my child to urgent care?
Yes.
If I have a family one? Oh, okay. That is good
absolutely.
to know.
If you have any most qualified medical expenses, you can use a HSA with. If you're going to the doctor, if you have different things like that, you can definitely use a HSA for those.
So it was flexible spending account that I was thinking about that does expire.
Yes.
What kinds of things were you buying with those? Or do you not necessarily recommend those?
No, it's actually very similar. You can buy pretty much the same items with a FSA and a HSA. It's just that the flexible spending account are the ones that do expire for that year. And the difference with the HSA is that you do have to have a high deductible plan to get a HSA.
Okay.
And so that's why I say sometimes it makes sense for some families. And I would say typically the rule would be if you are, an individual or a family that doesn't go to the doctor too often, then HSAs are great because you're basically prepaying your medical expenses and getting a tax deduction for it.
Got it. Okay. All right. I've got lots of questions I want to ask you about. I feel like we've done a lot on taxes, and you might still have some things, or at least a summary to go over when we come back after this break. But we also want to talk about moving forward in 2023, how to best prepare yourself to save the most amount of money. Start off on a good year where you're saving money, and maybe you can save more in 2023 than you did this year. We'll be right back. Welcome back to this week's Ask Amy. We do have Alan Pruitt here with Pruitt Prep CPA. So just to recap a little bit from some of our discussion, things that are different this year. And you said this, but in case people missed it, it's a big one, sort of an advisory, an alert from the IRS. What did they say?
They say be prepared for smaller refunds this year.
Womp womp.
Yeah, I know. Not the best news to hear, but at least we can kind of start planning now and expect that. So yeah, if you're usually expecting, a bigger refund, they are trying to taper expectations and let everyone know that refunds will be smaller this year. So there are a few different reasons why, because, as we kind of talked about from the top, there are so many things that are different this year than last.
Right.
One of the biggest things is, as we know, there are no stimulus checks this year. So no reimbursement for stimulus checks. One of the other things is that the advanced child tax credit, that, those direct payments, of course, those are done and over with and gone. And then we talked a lot about charitable deductions as well. For the last 2 years, the IRS would give you a charitable deduction even if you weren't able to itemize, even if you took the standard deduction. Last year, we were able to get $600 as a direct deduction. That is gone also. And then one of the bigger things for taxpayers with children is that the dependent care deduction has gone back to its normal levels, where that used to be $3,000 per kid. It went up to $8,000 per year that you could potentially write off exactly for dependent care. Now that is back down to its regular levels of $3,000. So that's the max credit that you'll be able to get per child for sending them to daycare.
Okay, and if you are not already taking advantage of that dependent care, I mean, maybe you think, oh, my child is no longer in daycare, they're in school. You can use that for summer camps. If you're a working parent and really you kind of use the summer camp programs, which can be very expensive as childcare, I mean, save those. Go back through and look at those payments that you made, because you can write those off as well. And I found that to be very helpful. That's not counted. That's not itemized deductions. That's just under the dependent care deduction.
Exactly. That is a direct credit, meaning, and the great thing about credits are dollar for dollar.
Okay.
So let's say you are getting a $1,000 refund, but then you get a $3,000 credit. Well, now you're getting a $4,000 refund. So we absolutely love credits. And to your point on the dependent care, it's called a dependent care FSA. You can actually contribute to that $5,000 per year So that reduces your taxable income. It saves it, for those dependent care expenses, and then you just reimburse yourself. So please check with your jobs to see if you have that dependent care option, because that is a very great tax benefit that, if you're going to be paying for daycare, you might as well contribute that money to there, and it's completely tax-free.
Yeah, absolutely. Now, you work a lot with small businesses and businesses on their sort of tax situation. And so what are they looking at? I mean, they want to look at some different things getting ready for the end of the year.
So a lot of different things for businesses. I tell all clients, if you're running a small business, then you certainly need to be consulting with a tax professional, preferably throughout the year, because there's so many things that business owners can write off that they don't often even realize. So one of the things I say for year-end tax planning, as we end the year, one of the things to look at is see if you can accelerate any of your expenses from January or February into this year. Because what that does is, so let's say you have some subscriptions for the year, everybody has annual subscriptions for software and things like that. If you're going to be paying that in January, see if you could prepay that in December. Because if you prepay that in December, that essentially, advances your tax deduction by 15 months. Because you think if you pay it in January, you won't be paying that until 2024, February, March 2024. But if you move that up just a few weeks, now you get the deduction for it now. So I always suggest accelerating expenses wherever it makes sense. We don't have to go crazy with it, but if you have a few different things, something you're buying, if you're planning on buying, furniture for an office, you have a few different things like that. Start putting those items into December. Along those same lines, if you can, tougher for goods-based companies, but if you are a service-based company, you can actually defer income. Defer sending out, a late December invoice until January, so we don't have to add that income into 2022. Once again, that gives us, 14, 15 months before we actually have to pay taxes on that money.
Got it. Okay, those things make a lot of sense. You mentioned something, and I don't want to derail us, get too far off track. But you mentioned, if you have some sort of expense with your business, you could move it up and do it in December as opposed to January, February. What about like homeowners? Because I have some maintenance items that need to be done, and it's a pretty high bill. But I was thinking that I was going to wait until January to do that. So then on my property tax protest, I could say, like, look at all this I had to spend to get my house up to, any sort of shape where anybody would want to buy it. Is there any benefit on my taxes for me doing that maintenance in 2022?
For homeowners, I would say just for the purpose that you mentioned, and maybe a property tax protest. Unfortunately for homeowners, now, unless you have a small business where you have, where you're running a small business out of your house, then, you don't get an additional, tax deduction for that, for moving that into December. Now, the only thing that you will is if you are one who pays your property taxes, if you pay your property taxes in December, make sure you pay those in December as opposed to January, because then we'll get the deduction for that in 2022.
Right. You want to write that off. Okay, awesome.
Exactly.
Let's talk about 2023. So moving into 2023, I mean, people always make New Year's resolutions, and a lot of times they're about saving money, being better with their money. I mean, and so there are a lot of ways that people can set themselves up to succeed and win those sort of goals or resolutions. And that would be having some sort of budget. But when you just say like budget, but then you don't put anything down or on paper or say what you mean by that. Kind of talk a little bit about that. There are several ways that you can do it.
Yes, absolutely. I know for a lot of people, budget is a scary term. A lot of people don't necessarily want to do it. However, a budget doesn't have to be scary. I think, two biggest things when I think about budgets is that, one, start with the end in mind. Think about where you want to be a year from now as you're ending 2023. What are your goals that you want to accomplish? Do you want to save more? Do you want to, pay down credit cards? Do you want to invest more? Start thinking about those things, because that's what you have to figure out. And then if we have those ideas in mind, we can start creating a plan now to accomplish those. So that was the first thing I think about. And then the second thing is that to get to where you want to go, you have to know where you are. And so you have to understand what your income is, what your expenses are, and then set a plan from there. So one of the things I like to mention to clients is that this is a great budgeting trick, is that if you're someone who gets paid every other week, meaning you get paid, every other Friday, then you actually have 26 pay periods in a year. But what I typically suggest to clients do is budget off of 24. So whatever your one paycheck is, so let's say you get paid $3,000 every Friday, right? So make your monthly budget off of $6,000. And then twice a year, you actually end up getting a bonus check. So you have another $6,000 throughout the year that you can use to pay down debt, that you use for travel expenses. I'm someone who loves traveling. And so we use that for, traveling expenses. But, use that as almost like making your own mini bonus.
Right.
By doing that. So budget off of 24 pay periods instead of 26.
Got it. That's an easy way. And you were talking about some other budgeting strategies that several sort of celebrities. I mean, Elizabeth Warren's not a celebrity. She's a politician, but she came up with a savings plan. Yes,
absolutely. So there are a few different a few different budgeting plans that you can, kind of incorporate. So one of them is called the zero sum budget. And so that one is Dave Ramsey. So what he says is, all of your income, as we just talked about. So let's say you have $6,000 per month that you're bringing in. We're going to budget off those 2 checks. Then put down all of your expenses, and then put down what your savings goals are, what your investing goals are, and then we sum it out to 0. So that $6,000, we have a plan to go to 0 with that money. Not that we're spending it all, but we want to have a plan for all of it. So that's one budgeting option.
Okay.
The second budgeting option is cash. It's called kind of like the envelope basis where, hey, we take cash out on the first of the month, and then, we have different envelopes. So let's say we want to spend no more than $200 dining. Well, you put $200 in your dining envelope. And then once it's gone, it's gone.
Right.
Put, $200 into your, grocery bill, whatever the amounts might be. That's another way to budget and really get a better understanding of where you are. Because as we know in this day and age, if you swipe a card, you don't necessarily think about it, especially if it's on a credit card. So that's a great way to really gain better control.
Alan, I'm oversimplifying this, but has anybody told Dave Ramsey that it is getting harder and harder to use cash everywhere you go?
Yes.
I mean,
yes,
like
it is.
So many businesses are like, no, we'll take your card. We're cashless.
Yes, and that is very, very true now. So that one that does make that one a little more complicated.
But the idea is that you can't overspend what you don't have in that envelope.
Exactly, bingo. And so that is definitely one. And then another one is like we mentioned with Elizabeth Warren, what she has a 50, 30, 20 type budget.
Okay.
So what you do for that is you budget 50% of your absolute needs. You budget 30 of your wants. So, hey, you enjoy going out to nice dinners, whatever the case might be. And then you budget 20 for investing.
Okay.
For investing and savings. So 50, 30, 20 is the one. So those are kind of 3 different options that we can, utilize there for creating a budget, creating a plan for this year. It doesn't have to be, overly complex. It doesn't have to be scary. I'm an accountant. I'm a CPA. I love my spreadsheets. My budget has VLOOKUPs and tied to different tabs. Your budget doesn't have to be that complex, but you need to know how much you're bringing in and then how much you're spending each month at its bare minimum, because then you can kind of accomplish those goals that we talked about, whether you want to pay down credit card debt, whether you want to save more, invest. That's how we get to those items.
Awesome. And that is time. I think your biggest goal is know where you want your money to go and make those plans. Thanks so much for joining us. If you look in our show notes, you will find a link to find Alan Pruitt and his CPA business. And we thank you so much for joining us today. Everybody have a great one.